Good day, fellow investors. You have to get ready because investing over the next decade will be much different than investing over the last 10-ish years, where stocks went from 666 points here at the bottom to the current 4,000, including dividends. That's an insane 7x return, which is something that never happened in history, but you have to understand that this happened because interest rates over the last 40 years and especially over the last decade were at zero, so nothing but down there. The central banks injected huge amounts of money into the system, which made financial markets go up. But this is a big danger because everything has changed now, but everyone is still living in the past, and you must not fall into that trap. Because if I type stock market into YouTube, it's all about what the market will do. Will it crash? Will it restart? Will there be a recession? What will be the market crash triggers? The end of this? Calm before the storm on a technical level? Could bonds trounce stocks in the coming months? Who knows what will the market do in the short-term period? So this is insanity. Following what institutions do, warning confirmed, the biggest crash of our lifetime, bear market over this pivot or that. Nobody can predict that, and especially over the long term. So be very careful not to fall into this trap over the next decade, because you cannot predict the market, but I'll give you a solution which is real investing, where no matter what the market does, you do well. And I firmly believe that's the only sane long-term compounding investment strategy. And let's now discuss what has changed and why it is so important. One of my favorite quotes when it comes to investing is that everything changes every 15 years. And if you can understand that, you will do much better when it comes to investing. You need to shift your paradigms every decade. As Charlie Munger said, Warren Buffett was successful because he learned something new every 10 years. Buying Apple, buying great businesses, shifting from Benjamin Graham, etc. Now the environment has changed because, as said, we see higher interest rates after a decade and more of very low inflation. Suddenly we have something called big inflation, a lot of red here, and it looks like it is here to stay for longer. Maybe it will go up and down, but when there is inflation, when there is higher interest rates, the stock market might not go nothing but up, and therefore you have to be an investor, not everything goes up, a rising tide lifts all boats kind of investor. You have to start to think. Because if we just look at the market over the last 4 decades, I think now we are in a repetition of the 1990s, but you cannot lower interest rates anymore. So we had a bubble, then another bubble, now has peaked here. And what happened after the previous bubble? The stock market went nowhere for 12 years. It went up and down, but as I said, you cannot predict those short-term ups and downs. You have to see how to invest if the stock market does nothing for a decade or even more. And what has changed is that we have rates up, inflation, and even more importantly, given the big debt burdens, slow, if any, real economic growth over time. And therefore, we have to focus on real investing. And real investing is when you don't care about the market. When you invest your money, whatever the market does, it doesn't matter to you, because you know what you bought, why you bought it, and what will provide value for you. And the core focus there is something that was forgotten over the last 40 years because stocks went nothing but up. And that is fundamental analysis, focusing on owning a business from an owner perspective, not speculating about the market. As we have seen with the YouTube craziness there, everything is about the market, but real investing is about focusing on businesses. And let's look at our educational YouTube portfolio, go business by business there and see what is real investing. And I hope this will make you understand how to invest for the next decade and therefore provide you huge value. So, Warner Bros. Discovery, nothing to do with the market. If they can reach their cash flows, then that's the catalyst that will trigger returns for investors. Oversold because AT&T investors know only about dividends, so nothing to do about the market. This is an investment. This is pure market. If it goes up and down, our Tesla short, so this is just for fun. As said, this is an educational portfolio, so we do a lot of things. We do also all weather, so this is a play on the market, but we try to take advantage of the craziness by taking advantage of the volatility. I think I have to soon sell the second buy and there also make a profit. Not really about the market. It's a meta long-term bet on the fundamentals. So that is, again, whatever happens to the market, this has its own separated risk and reward. This was an investment because the P ratio was very low, 8. It was oversold. And you take also advantage by the craziness of the market by buying. And I think in the month it's something crazy, 50% up. And if you want to learn more about investing, follow my margin of safety book summary. I'll put the link to the playlist in the description below. And there is also how to trade, how to manage your portfolio. And that is also a core note on investing for the next decade. Continuing on our business ownerships, Intel has the potential to make 20 and more billion in earnings. And if they do that in 2027, the stock will double, no matter what the market does. Google, if they grow at 10%, P ratio of 20, which means 5% earnings yield, you have a 15% return per year, no matter what the market does. This is 60% up, as we just discussed. We sold, we made the money, whatever the market did. The market is actually down since he bought it. This is expensive. We just follow when the market gives us our opportunity. Similarly here, ADM and Apple, pricey, extremely expensive. Also, this is high dividend yield and great business at a fair price. If it goes lower, we follow. And that is real investing. And you have to ask yourself, whatever investment you make, whatever money you set aside into something, do I need the market to give me a return there, to do something good for me? If you invest in something and you say, I'm happy with the business, with the dividend, whatever the market does, I don't care, that's investing, and that will do well for you over the next decade. If you invest in something and I think it will go up because the market will go up, then you are speculating, and that's unlikely. It might do good, you never know, but it's unlikely that it will do good over the next decade. And I think it's better to make it a win-win situation so that if the market goes up, you win, but even if it doesn't go up, you win, which then makes your portfolio win and you have a great return. To make this a better example, so let's say the mid-case scenario with Google is this 15% per year now, but if there is a recession and they don't grow as fast, if they grow just 5%, plus 5% earnings, that's a 10% return per year, which is still good. Of course, you have the exuberant scenario, which is 20% per year. You can hear more about that in our Google video, again in the link in the description below. So the point here is that even if this happens over the next decade, you have to be ready, you have to know how to invest, and you can follow this channel, but if you want also more businesses to own, business ideas to own, you can check my research platform, because that's what I do. I try to find interesting investments so that no matter what happens to the market, I do okay financially. That's the core. Let me know what you think in the comments, and I'll see you in the next video.